joining us in studio to discuss his company's full year financials is Nedbank Chief Executive Mike Brown. Well, I got a little bit of a frown from Sasha Narishkin a bit earlier when I said to him, these are disappointing numbers from Nedbank. You're up 16% in the first half, you're 13% for the year as a whole. Looks like things have slowed down in the second half. Tell us the truth.
I think things did slow down in the second half, Alec, and I think we expected them to slow down. Overall 14% growth at a headline earnings level, slightly less than that at diluted headline earnings per share. We probably still finished the year better than we expected. If I'd been sitting in your chair here a year ago, we said our forecast for diluted headline earnings per share growth was going to be above nominal GDP plus CPI. Our medium to long-term target is GDP plus CPI plus 5, and we didn't add that extra 0.5 in our forecast, an extra 5% in our forecast last year. And looking back, we actually just achieved it, depending where GDP finishes.
Take us through that, because you're very good at targeting, and you have cost of capital, shareholders' capital, plus 5% is the target that you're looking at, for instance, on return on equity.
That's right.
I remember years gone by, banks would say, well, at least 20%. In fact, when you were coming out of the trough, you were saying at Nedbank, 20% return on equity. Now, cost of capital plus 5 is a long way from 20%, yet in the year ahead, you're not sure that you're going to get even there.
So cost of capital plus 5% is our ROE target, and right now that would probably be somewhere around about 18%. The return on capital we produced in last year's numbers was 17.2%. And I think generally what you've seen is that the world of banking has changed dramatically since 5 or 6 years ago. Capital levels have increased significantly.
How much does that cost you, the increase in the capital levels?
So I think in terms of ROE, at least 5%, probably more. And interestingly, if you look at the components of ROE, without getting too technical, is effectively your return on assets times gearing. And our return on assets now at 1.27% is very similar to what it was pre the global financial crisis. Our capital levels at 11.6 are significantly higher.
What are some of the challenges then counteracting this growth?
So I think the real challenge at the moment is the macroeconomic environment. Banks, maybe more than any other industry, are a product of the macroeconomic environment that they operate in. So the slower growth environment, particularly here in South Africa, does make it difficult, particularly on the retail side of our business, where we see consumers under pressure. And then we've got to try and say, well, if growth in South Africa is going to be slower, how do we continue to grow our franchise by following many of our corporate customers who are looking for growth in the rest of Africa?
And that's EcoBank.
So the way that we think about it is, strategically we've said that in Central and West Africa, we've chosen a partnership approach, and ETI or EcoBank is our partner. But in Southern and East Africa, these are markets that are closer to home, where we think our business has competitive advantage to compete as Nedbank. So Southern and East Africa, we want to grow the Nedbank franchise.
Able was a big story in around August. We're clearly right in the middle of this financial year. How did it affect Nedbank?
So from a financial point of view, very little effect. We had no direct exposure to African Bank. Clearly a number of our customers would have had exposure in money market funds, where the underlying funds themselves were invested in African Bank. And that was very difficult for us. It's very difficult when your customers don't make the returns that you would expect them to make. Fortunately, we had relatively small exposure there, and I know I was one of the customers invested in our money market fund, so I didn't make the return that I was expecting. It's certainly likely to have an impact on banks' ability to access debt capital markets going forward, because at its most basic level, I think many asset managers weren't appropriately taking account of the risk that they were taking for the extra return that they were getting for investing in instruments like African Bank senior debt or African Bank subordinated debt. So I think going forward, anybody issuing into debt capital markets is likely to pay a premium above what they previously would have paid.
Having a look at the year ahead, you've now put on the table 13% headline earnings growth, 15% dividend growth. You're saying in your targets that your ROE won't get up to your targeted levels. What kind of numbers are you working on internally for profits?
So I think if we go back to the forecast that we give the market, which is diluted headline earnings per share, what we're saying to the market is exactly what we told them 12 months ago. We think we can grow diluted headline earnings per share more than nominal GDP growth in 2015. But again, too early to say whether we'll be able to get that 5% above that again in 15.
That's poor. That's hardly, with 1.5% GDP, adds 5% inflation with the petrol price coming in. You're talking, what's that, 6.5%? That's a very low ball kind of focus.
So clearly we say greater than that. So we would like to grow more than that. But it's quite difficult to say, 6.5%, 7%, you put 5 on top of that, you're pretty close to 12. We've just produced 13 in the prior period. And I think 2015 is going to be another difficult year. So, it's difficult to put the 5 on this early in the financial year.
Can banks ever go back to shooting the lights out as they used to do in the past, given these new capital ratios that you have?
So I think that return on capital is certainly likely to be sustainably 5% lower than it would have been when banks were hitting 25% ROEs. I do think it's possible to get return on capital levels, certainly for Nedbank, closer to the 18 to 20% than where we currently are now.
How?
But to do that, it's going to require the economy to grow at 3 or 4%. And that certainly, in our view, is probably 2 or 3 years out.
So with the budget speech coming up on Thursday, are you optimistic?
So I think the minister's got a very difficult task during the course of this week. I think he's got to demonstrate to both global investors and rating agencies that we've got a handle on expense growth from a government point of view, but at the same time that some of the very unfortunate issues that we've seen emerging in the revenue service, which has been one of our finest institutions, hasn't impacted on their revenue collection abilities and hence the fiscal deficit. So I think he's got a very tight line to tread this week.
Well, we'll leave it there. Thank you so much to Nedbank Chief Executive there, Mike Brown.
And we made it through this interview without having an earth tremor. Thank you, Mike.
Ah.
You moved the world last time you were here. But I think shareholders are quite happy with this. It's no doubt one must have a look into the future with banks, maybe with a, as you've just articulated to us, with a more conservative approach towards the returns.
Alec, I think that's right. But if you look at where analyst consensus was, it was for 11% growth, and we produced 13. If you were a Nedbank shareholder last year, with dividends and share price growth, you'd have had 23% growth during the course of 2014. So we think that that's a solid outcome.
Thanks again for your time, Mike. That was Mike Brown, Chief Executive there of Nedbank.